All right, listen, it began with great fanfare, right? Finally, retail investors, you got a chance to invest like the elites. Now, the implied promise was returns like those Wall Street kingpins. You were going to do so great putting this stuff in your 401k. Instead, well, what's happening is sort of like that famous scene in A Bronx Tale, now you can't leave. Yesterday, Apollo moved to limit their withdrawals, and then this morning we come in, Ares did the same thing. Now, my next guest says that the explosion of private credit strategies is a classic tale of Wall Street greed. Joining me now, Whalen Global Advisors, Christopher Whalen. You know what, let's start first, if we can, with the pieces of the puzzle. Just some of the terms, some of these things that float around, PIC, payment in kind, BDC, business development company, PC, private credit. Just, you know, like PIC, for instance, what does that mean?
That means when a company doesn't have the cash to pay its debt, they give you equity instead.
Okay.
I mean, they're in default, but a lot of times these private portfolio companies that have been sponsored by private equity, they run out of cash and they should be wound up, but they can't sell them.
And that's what's hurting Blue Owl, I think, the most, right?
Yes,
I mean,
very much,
yeah.
but others as well.
Yeah, and of course, business development companies, we kind of know what that's self-explanatory, and private,
that's right.
Yeah, private credit. So, private equity returns have been touted for years, right? I mean, these guys get paid billions of dollars a year.
That's right.
$1 billion a year, and you know, apparently we always thought they earned it. And if you're lucky enough to invest with them, you're doing well. But over the last 1, 3, and 5 years, you'd have been better off investing in just in the S&P.
Oh, early on, Charles, it was a small game. Only a few very big institutional investors, pension funds, Harvard, for example. But as the game got bigger, the quality went down. And that's the problem. They can't sell these companies. They can't IPO them. They can't liquefy the investments. So they just sit there. And that's what the industry is facing today. Roughly about 1 in 5 private portfolio companies in private equity are unsaleable. They're just stuck in the system, and the sponsors are stuck too.
Right.
Because everybody knows what's going on, but they're all subject to contractual limitations, non-disclosure agreements, so they can't actually complain. They can't file lawsuits. So that it's the silence of the lambs, really, is what we got
right.
here.
And you know, you say, you know, the sponsors of private credit strategies hide behind contracts, non-disclosure agreements, and it prevents investors from protecting their own legal rights.
Yeah, the investors have no rights. In order to participate in private equity and private credit, you've got to sign away all your rights. You have to depend on them to do right by you.
So ultimately, you say this is why private credit and equity is a rigged game.
I think it is. The big problem was letting retail investors in.
Right.
Big people, private equity, people with long-term horizons, that's not a problem. They understand what they're getting into. But you know, your typical retail investor, even a high net worth individual, they don't have tolerance for liquidity risk. As soon as they sense something's wrong, they all run for the door.
Well, and the thing is, Chris, what I'm hearing is a lot of people saying, well, buyer beware, or you should have known better. This is how the industry works. Don't cry about it. But this is marketed to people in their 401ks.
That's right.
I mean, if I want to dip, if I want my retirement fund, you mean I may not have access to the money I've worked my entire life for?
That's right. And you know what? It violates that basic rule of the securities business, suitability. These investments were not suitable for retail.
Right.
And yet the sponsors saw the fees and they figured, well, we'll make the pie bigger, we'll make more money.
I'm worried right now from a contagion point of view. I just use KBE as a proxy. It's down, the market's down, so you can say maybe it's just down with the market. But you know, you always got to start worrying about contagion or possible contagion risk out there.
I think at the moment it's a private problem and it's going to be resolved privately. The banks do have exposure here, and they're doing their best to hide the ball. So we'll find out probably in the next quarter's earnings release how much exposure is there. But I think really this is the pain is going to be felt first and foremost by investors, then credit investors, people who have loans to these companies, and thirdly, the banks.
What should be done? What can be done? I mean, should Congress look into this?
Yes.
You know, yeah.
The whole notion that private markets are better than public markets is wrong. And the fact that you had the leaders of some of the biggest private equity sponsors out selling this nonsense is wrong. Congress ought to hold these people to account.
Yeah, but they also write a lot of checks to Congress.
Yes, they do.
I hate to say it, but they write some big checks to Congress.
Yes, they do.
Chris, your work has been phenomenal. It's always been phenomenal, but I'm glad you came to help us with this.
Anytime, Charles.
Thank you.